All right, let's see. Sydney. No. Ty. Mayo. Vanessa. Physic here. By the way, Jared, I have his permission to say this. He has COVID, so if you were sitting next to him, you may think about being tested. Henderson and me. Martha's here. Tyler's. No. And Tucci's here. And Blake's here. All right. I hope you had a good break. I kind of had a miserable one, especially yesterday. Yeah, I was basically puking all night long. Maybe food poisoning. I don't know. I hope it's not something serious. That's one of the reasons my voice is kind of a little bit bad. Today we're going to talk about balance of payments. I'm going to spend only one lecture on this, kind of to create a background on sorts of things that may affect exchange rates. I'm not going to go over the balance of payments accounting since we're not going to do any exercising with it. You know how to do debits and credits. If you guys want, you can read it. But I want to spend time on balance of payments accounts, different accounts. What do they mean? You know, where is the balance coming from? You know, the so-called balance of payments identity. But we're going to spend more time on what sort of trends are there in major countries. Now, in terms of accounts, the accounting for balance of payments is a little bit different than regular accounting. It's more like a cash accounting. There is still double entry bookkeeping, uh, but it's not the accruals that matters. The reason we keep something like balance of payments accounts is to figure out what sort of uh, imports and exports of goods and services a country has. We divide these accounts into basically four. One of the more important one is the so-called current account. It includes exports and imports of goods, but also services. You know, if your company is a consulting company and you have a foreign client, they bought a service from you, even though technically you're not exporting any goods, you sold the service to a foreign country and they paid you money. So that would be an export of service, for example. We're going to look at current accounts first and foremost to figure out what sort of pressures there may be in a country's exchange rate. We will also look at the capital account. Capital account basically tells you, to some extent, uh, how the current account deficits, if any, are financed. If your country has more imports of goods and services than exports, you're going to have a current account deficit. If it is less, you're going to have a current account surplus. For example, US, probably the last 40, 50 years, has chronically current account deficits, but capital account tells you how it is financed. Where is that money coming from? You know, if you buy more than you sold, that means some money is going out of your country. So how are you financing that? Capital account basically tells you any capital transfers, could be loans, long-term investments, any cross-border acquisitions, and so on and so forth. The so-called financial account, excluding the official reserves, these are the reserves of the central bank. That includes all purchases and sales of financial assets, such as stocks, bonds, bank accounts, and the official reserve account covers all purchases and sales of international reserve assets. For example, Federal Reserve, which is the U.S. Central Bank, buys euros, sells euros, buys yens, buys and sells gold, silver. Those are all international reserve assets. So that would be in the official reserve account. In the old days, that was relatively an important item, but nowadays, especially for major countries, not much. Here's an example. These are for 2018. Uh, we'll also look at some current numbers, but for US, exports are viewed as credits. You sell stuff and money comes into your country, about $2.5 trillion. Of those, 1.67 is goods, the other is services. Imports, on the other hand, is over $3 trillion. Of those, about 2.5 are imports of goods, stuff you buy from China, and also services. This primary income, these are incomes of US nationals uh, that are earned in foreign countries. So if a US national lives in Germany and they earn income there, that would be income. The balance on the current account uh, is about almost $500 billion. The capital account has a balance of 9.4, and the financial account, uh, US technically financial is also a capital account, but it's kind of a sub item. Look at the direct investments. Do you know the difference between direct investment and portfolio investment? If a Japanese investor buys 1,000 shares of Google, that would be portfolio investment. Yes. 1,000 shares of Google doesn't give you any control rights. But if a Japanese firm invests money to establish a factory here, that would be foreign direct investment. And, that matters because portfolio investment is fickle. If people think that US assets are not that desirable anymore, they can take that money out. But think about the Toyota plant in Georgetown. They probably spent $1 billion in there. That money is not going to be out anytime soon because it's going to cost them a lot of money to do it. And selling a specialized factory like that is not going to be that easy. So if a lot of your financial accounts credits are in terms of direct investment, it is more desirable compared to portfolio investments. Again, we have the breakdown of the portfolio. Uh, about a third in stocks, close to half in debt securities, basically bonds and stuff. This is a lot higher now.